Mehul, I'm really excited to have you back on, man. This is round two. You came on for critical illness insurance. That was a really well received episode, and I can't believe it's been this long. So, welcome back to the show.
Thank you, Yethan. I always love having conversations with you, and it is really nice to be on the other side of the mic, so to speak. So, really looking forward to this.
Yeah, and I do want to let people know that you are doing a really good job with your podcast. I had a chance to listen to some of your recent episodes. So, Mehul, can you just kick things off by telling us a little bit about your podcast, what you cover, and where people can find it?
Absolutely, yeah. So, it is a podcast that is sort of put out through my firm, Westmount Wealth, and it's called Mind Your Money. It is a second iteration of a podcast I began during COVID, which was called Mind Your Biz.
Hmm.
And we kind of sort of narrowed the topics that we wanted to talk about to really focusing on financial planning based topics for Canadians. So we hit topics such as retirement, tax, should you have a hold co? What does estate planning look like? Just getting your wills and POAs in order, trust planning, even topics like real estate investing and things like that. So it's definitely more focused than it was before. I think that Canadians can get a lot of value from it, not just physicians, but Canadians in general. It's on Spotify and Apple, and it's probably one of my most favorite things to do.
I love it. I think you're doing a great job.
Thank you.
And Mehul, just so people can get a bit of a refresher, just tell people about what you do professionally and how long you've been doing it.
Yeah, absolutely. So I am a certified financial planning professional through designations, as well as a trust and estate practitioner again through Step Canada. But really, what I do is I help, for the lack of a better term, I guess, high net worth individuals, high income individuals, be it professionals and business owners, really get a full view on their estate planning reality. And what that means, and we'll get into it obviously in this episode, is practically speaking, what does your estate liability look like? What are the things we can do today to either help minimize or cap that? And what are some of the things we can set up for the future so that when you eventually are going to be passing those assets down to the next generation, we have a mechanism to do so. And so that's what I focus on. I do that all day, every day. I've been doing it for 17 years in some form or another. I'm not an investment person. I don't manage assets. I leave that to the other fellows in my organization. And I'm obsessed with this stuff. As you know, we've had these conversations. I really am obsessed with this type of planning.
Yeah, so death and taxes, Mehul. Let's get into it. And I will share one quick story. Last night, I had the chance to go watch some tennis at the National Bank Open. And I was talking to one of my friends there, and I told them I was going to be talking to you about the various layers of tax that can impact your estate should one die unexpectedly. Let's say you have a corporation and a hold co. So, what exactly happens? And he looked at me and he said, yeah, then that's a great topic. One I could tell you, Mehul, that a lot of us don't know much about. So let me paint the picture here. Let's say we have a medical professional and they have an operating company, the OPCO, and then they also have a holding company. And let's say inside that corporate structure, they have a mix of assets, some stocks, some investments in private equity, and then some real estate. And let's say all of that totals to around $10 million. And then let's say this individual was to die unexpectedly. Talk to us, Mehul, about what are the various layers of tax in this situation that the estate would face.
Yeah, this is a very important topic, and much like the conversation you had yesterday, when I speak with business owners and incorporated professionals around this, they don't know. They don't have a clue. So first and foremost, I think when we need to delineate or really sort of state here is that there's no estate tax in Canada as there is in the US. Okay, what we have instead is this thing, which I think you've covered before, but it's called deemed disposition, right? And what that basically means is that you are deemed to have disposed of all of your assets the moment you passed away or just before you passed away, based on the fair market value of those assets. Now, we know through capital gains rules here in Canada A capital gain is the difference between the fair market value at the time of disposition and the adjusted cost base, or let's think of it very simply as how much did you pay for that thing originally?
Hmm.
So if we use a piece of real estate, it's probably the easiest example people can resonate with, not your principal residence, because that's tax exempt. But an investment property, for example, you buy it for $1 million, and when you dispose of it, be it deemed or otherwise, maybe you just sell it, it's worth 2 million. There's $1 million capital gain.
Hmm.
Under the current regime and the current tax rules, it is still only being only 50% of that gain is being taxed. There was a attempt, or at least a proposition, to increase that amount that would be taxed to 2/3. That didn't go through. It didn't materialize. Is it gone forever? That's a different conversation for a different day. But as it stands right now, 50% of it is taxed. So 50% of that $1 million, $500,000, is now taxable at your marginal tax rate. If we assume the highest rate, let's just, for province to province it varies, but let's just call it
Hmm.
50% so that it's sort of easy math for my brain, and it kind of anyone in Canada can kind of relate to it there. You're paying $250,000 in tax on that. Now, that's great because you sold it and you get the other 750,000. Now, we're just assuming this is done at a personal level. We haven't even talked about what happens when you do that in a corporation. That
Hmm.
being said, that's called the capital gain. That's the capital gains calculation on that disposition. But at death, you didn't actually sell it. It was just deemed to have been disposed.
Hmm.
This is CRA's opportunity to go in there and tax all the gains on all of the assets that you own upon your death. And that is what the tax liability to your estate is here in Canada. So that's layer number one. Okay,
Hmm.
so this individual died. Their holdco, I'm going to assume the opco, the medco is not really worth anything. The opco has the $10 million. What does the person own? The opco own, the holdco owns those assets, but the person, the physician, owns the shares. So they're deemed to have disposed of those shares.
Hmm.
It doesn't matter what the adjusted cost base of those underlying assets are. It's what is the ACB of those shares.
Hmm.
And in most cases, unless, assuming nothing else has happened throughout the life of that holdco, it's a nominal amount.
Hmm.
Maybe $100, maybe $10, maybe $1,000, depending on how they started in share classes, how many shares are issued. But let's just call it nominal. That's a full, all intents and purposes, that's a $10 million gain, 5 million of which is taxable. That is a $2.5 million tax bill to the physician.
So, where I get a little bit confused, and I'm just going to be talking out loud here, is let's just focus on maybe the stock piece, for example, in that holding company. Even though some people will invest into stocks through their corporate investing accounts, let's just say we're doing it through our holdco. Let's say I had investments in a company, and let's just say I spent $500,000 on those investments. And if I hold them for the long term, maybe it's a real compounder, and let's just say that $500,000 goes to, let's just say, 2 million. Did I not pay $500,000 to get to the 2 million? Hence, the cap gain is 1.5 million. I know you just discussed the nominal cost of these shares, but I just want to differentiate the shares and the cost of my investments. Do you know what I'm getting at?
Yeah,
That's where I'm.
absolutely.
Yeah.
Yeah, and that is the cause of confusion, and that is the argument. But you didn't put $500,000 into the investment. Your holdco did. You never
Okay.
did. And
Okay.
remember, that money has not been transferred out to you, and you have not paid
Mm.
tax on that money. That is not your money. That is the holdco's money. But we're alluding to a larger problem because, okay, we've got this $2.5 million tax bill due to the deemed disposition of those shares. Now, let's just assume, which I think this is a fairly fair assumption to make because it's a common situation where that individual, that physician, does not have, their estate does not have $2.5 million of cash
Hmm.
to pay that tax bill. And probably because they left most of their money invested in their holdco. They didn't want to pay the additional personal tax to take that money out of
Hmm.
their holdco
Hmm.
during their lifetime. So personally, as a physician, they're sort of cash poor. Everything's in the holdco.
Hmm.
Does that make sense? Is that fair to say,
Hmm.
assume?
Hmm.
So there is a situation now where the executor or the estate has to come up with this money, and the most logical or the most obvious way to do that is to start selling, is to get that money from the corp. Okay, but that
Hmm.
corp owns assets; those that money is invested, and just like you mentioned, there are embedded gains in those assets. So let's
Hmm.
say they do decide to sell out that portfolio. And let's just say it was a compounder. It was very easy. We won't think about income along the way that was paid and dividends and things like that. It was all just deferred gains, buy and hold strategy. It was $500,000 that was invested, right, of after tax money from the
Hmm.
opco that transferred to the holdco on a tax-free intercorporate dividend. It was invested and it grew from 5 million to 2.5 million or whatever that number is. There's a $2 million gain. You want to sell out all of that and take that cash. Guess what? You just triggered another layer of tax.
Oh man. Okay. So let me just, Mayo, sorry, this conversation is not off to a good start. Unfortunately, I'm hearing a lot of things I don't want to
Yeah,
hear. But
don't shoot the messenger.
okay. So the first layer of tax, you talked about the deemed disposition, which is basically the difference between the fair market value of your assets and the adjusted cost base. And because we're holding these assets in a corporation, you alluded to what was the cost of the, I guess, shares for that corporation, very nominal cost. So let's say we have a $10 million holdco full of assets. There's a very large deemed disposition. That's layer one. And then if we don't have liquidity within, like let's say that holdco wasn't hanging on to cash and there are taxes to pay, then some of those assets are going to have to be sold off, resulting in the second layer of tax, which is the
Correct.
capital gain on that specific asset. Is that
That is
accurate?
correct. Yeah, and the only
Okay.
thing I will say, just to maybe fill in the blanks a bit, is
Hmm.
that initial deemed disposition on death. Let's be very clear.
Hmm.
You are deemed to have disposed those shares in the holdco that you
Hmm.
own.
Hmm.
That is technically exactly what is triggering the tax.
Okay. Before I jump into my next question, are there any other layers
Oh
of
yeah, we're
tax
not
or?
done yet. We're not
Okay.
done. We're not done. Right? It's a three strikes you're out type of world here. So we have to do the third strike. The third strike here is okay. Your holdco has sold enough assets to provide the liquidity to supply the liquidity to your estate to pay that tax bill due to the deemed disposition of the shares in holdco.
Hmm.
But that money's got to come out of holdco. Right?
Right.
So
Right.
Holdco now pays the tax on the disposition of the assets inside Holdco to get the liquidity. But now Holdco has to pay that to the estate. Absence of any other planning, a good chunk of that money, that liquidity, is going to come out as a taxable dividend.
Hmm.
Okay. Now, we can't just say all of it's coming out. What happens is when you sell a capital asset, when you sell an asset and there's a
Hmm.
capital gain, we know 50% of it is taxable, which suggests that the other 50% is non-taxable,
Hmm.
right? So inclusion rate's 50%, 50% included, 50% not included. Due to because of the rules of integration, that tax-free nature of half of that capital gain must remain. That tax-free nature must remain all the way
Hmm.
through from corporation all the way to the physician's, well, estate essentially.
Hmm.
Okay. And this isn't just on death. Anytime there's a capital gain realized in a corporation,
Hmm.
half is taxed, half is not. And that half that is not taxed, that creates an equivalent credit to this notional account called the CDA or the capital dividend account. And
Hmm.
what we know about the CDA is that dividends paid from the capital dividend account, the CDA, are paid out tax free. So there's a little bit of redemption there. There's some CDA created. So in our example, it was a $2 million gain, right? $500,000 invested, $2.5 million liquidated, fair market value, $2 million gain. Million is taxed, million is not. That's $1 million credit to the CDA. That
Okay.
can flow out tax free.
Okay.
The
Hey.
other the other million will come out as a taxable dividend.
Yeah.
However, there is going to be some refundable dividend tax on hand generated as well, just to make
Hmm.
sure that there's no over taxation. But be aware there is a technically a third layer of taxation there.
Okay. I was going to say CDA. That's my favorite type of account. Like you're talking my language now. So okay,
CDA
Mehul, I
good.
just yeah. So before we jump ahead, I just want to make sure this situation, like roughly speaking, how much tax are we talking if there's no planning done?
Yeah,
And
so this is where that term of triple, double and triple taxation comes up. And so
mhm,
instead of talking about the dollar amount, because everyone's situation is going to be different, you look at the effective amount of tax you've paid. So you looked at how much tax has been paid, right? Total in
mhm,
all different layers. So
mhm,
layer one to the estate, the corp, and then the dividend out. You look at that and you do that as a function of the overall value of that corporation, of that holdco, of that estate. And you start looking at what that effective tax rate is, and it starts jumping north of 50% pretty quickly, and even as high as 75. So if we think of the effective tax rate on a typical capital gain is about 26%,
mhm.
you're essentially getting as high as 75. You're essentially paying triple tax, but definitely double tax. So you're definitely in the double tax category.
Mhm.
And in certain cases, depending on the size of the gain, you could get into a triple tax category.
Oh man. Okay. Let's move on to the next question. I wanted to ask you about an estate freeze. Let's just say this holdco owns stocks, private equity, some real estate, technically not a sellable business. Is an estate freeze at all applicable here?
Yeah, so you can definitely freeze a corporation, any corporation, and it's going to be like, why? Why do you want to go through this estate freeze? So what is a freeze? We're essentially
Yeah.
freezing the business owner, in this case, the corporation's owner, shareholder, in this case, the physician's ownership in that holdco. Okay, so like today, let's say he doesn't pass away suddenly today. He's not passing away for another
Hmm.
20, 30 years. But today he's got that $10 million. And I'm going to get into something very important in a second, but it has been decided, it has been demonstrated that $10 million is enough, okay, for
Hmm.
today
Hmm.
and for the rest of his life. That's enough that he has. He doesn't need any more, say, funds, any more money for the rest of his life. Okay. And so we can freeze his interest at $10 million, crystallize it. So what he's
Hmm.
essentially doing is he's swapping those common shares that he owns in Holdco for frozen preferred shares at a frozen
Hmm.
value of 10 million.
Hmm.
And the common shares typically would go into a family trust where his kids and maybe whoever could be beneficiaries. I mean, he himself could be a beneficiary as well, just in case he wants
Hmm.
to partake in the value of the common shares. But the ongoing growth, anything north of 10 million post freeze, will now be attributed to essentially through the trust, the beneficiaries of that trust. So
Okay.
what he's doing is he is now capping his estate liability. And in the planning world, much like I'm sure in the medical world, we like predictability.
Hmm.
We like when there's certainty, right? There's enough uncertainty in the planning world. We like when there's certain things that can be certain. So if you tell me this person's tax liability is crystallized at $2.5 million, I can now start planning around that. Accountants can start planning around that. But if we're just making projections, hey, I don't know how the market's going to go, how that real estate's going to appreciate, if they're going to acquire more things, is Tesla going to go on another run? I don't know. All of a sudden now, when he passes away, that you know tax liability is
Hmm.
20, 30, 40 million, right? It's a whole different ball game, so to speak. So the
So,
freeze is
Mehul,
very important.
yeah. Okay. So, I just want to make sure I understand, though, for a medical professional who doesn't have a sellable clinic or a sellable business, you're saying that an estate freeze is still an option on the table?
On the holdco, yes. If they have a
Yeah.
holding
Okay.
company, they would, and they have assets in there, and
Okay.
it's enough assets, they can freeze their interest in it.
Okay.
Yeah,
Okay. Now let's move beyond this and let's just say the medical professional in this case they pass away. What are some of the strategies that can be used post mortem to reduce the tax hit? Like to
yeah,
reduce those various layers that we talked about in
yeah,
question one. How do we reduce that?
yeah. And thank goodness there are provisions in the Tax Act that do allow for some to negate or mitigate some of that tax, that double and triple taxation. There's two that I want to kind of bring up. The first one is is subsection 164.6, which points towards the loss carryback provision in income tax. And what you're essentially doing is creating an artificial loss by having the estate redeem the shares of the corporation that is in question here. And when you do that, you create a loss because of that bump up in ACB after you die. And you can carry that loss back to the final taxer of the deceased individual, that terminal tax return, and essentially wipe out that capital gain. However, it's not a magical stroke of a pen. It's not like
Hmm.
poof, that capital gain's gone. What we've actually done isn't necessarily the best thing because we have converted a more tax efficient capital gain to a higher tax dividend
Mm.
because you've now skipped on that capital gain on the terminal tax return of that deceased individual, but you've now created a dividend tax if you want to extract any of that to the estate.
Okay.
So the estate wants to get any of that as a full dividend. So where 164.6 works really well is where that corporation has a good chunk of CDA room.
Okay.
Okay,
Okay.
because that's going to be the most tax efficient way to get anything out of that corporation.
Okay. So by generating this loss, just so I understand, we are effectively reducing that first layer of tax we
Hmm.
talked about
That's right.
on the estate, but at the cost of potentially making the dividends pulled out a little bit more expensive. And then you alluded to the CDA. If there is CDA room, then this can be a worthwhile strategy.
Yes. So if there's a
Yeah.
way that we can
Okay.
create CDA room, this can work really, really well. So that's the first strategy. Another
Okay.
very common strategy is what's called a pipeline
Mm.
strategy. Okay. And again, what we're doing here is essentially it's more of a tax deferral mechanism.
Hmm.
Okay, so we're opening up the estate will open up a second corporation, and it will purchase essentially that holding company, the corporation in question, for a promissory note.
Hmm.
And there are some rules around that, and then essentially that promissory note can be paid back over time. There's some very strict rules around how that has to take place with respect to CRA, how long the business has to keep running, or the holding company that has to keep running. How long you can't just pay off that promissory note right away. It needs to be done over time, right? And the question also becomes is like, how are we paying back that promissory note?
Hmm.
Right? So that in and of itself, if there isn't liquidity, can trigger tax, or if there isn't cash flow, there can trigger taxation along the way. It works well in companies where there is cash flow. Traditionally, works really well in operating companies, and really, really lends itself to like intergenerational. When you're passing a business from one gen to
Hmm.
the next, it's actually perfect because that next gen is going to be keeping that business going indefinitely, so they have time to pay off that promissory note over time.
Who's eligible for this pipeline strategy? Like, does there have to be an ongoing business in place that's actually conducting business, or is it essentially available to any holdco or any opco?
Yeah, I mean, technically, I think the wording says that there does need to be an ongoing business, but how you define business in this particular context is different. If
Mm.
you are a holdco that manages investments, and they have real estate and and an investment portfolio, stock portfolio, public market portfolio, private investments, and all that, and it's generating income, is that a business? Right? It doesn't say anything about active or passive business or anything like that. That's not the definition we're after here. It's really just about, is there an ongoing business with ongoing cash flow, and that's
Okay.
kind of what lends itself to it. The big thing here is like they basically want you to wait and keep that business ongoing for at least a year, preferably
Okay.
two.
Okay. I just want to emphasize to listeners, like, we're talking about a lot of new concepts here, and I think that some of the strategies that Mehul just touched on, like, these could be podcast episodes on their own. And the purpose of today is really to highlight things from a bigger picture. So at least you've heard of these topics. And so let's say you wanted to touch base with the professionals in your network. Well, hopefully after an episode like this, you know some of the terms and you know some of the questions to ask. Like, I just want to be clear. Some of these topics could be podcasts on their own, but we're hoping to give people an overview. Now, Mehul, What about our wills? Like a will is something that I unfortunately delayed for about 5 years, and then early in 2023, I finally got things done. But to allow some of this planning to take place that you've described, do our wills need to be changed to allow this to be happen? Perhaps you can touch on that.
Yeah, that's such a great point and so overlooked, right? This postmortem planning, especially if you're, mid-career, middle-aged physician, statistically you have lots of life in front of you. You're going to go hear about these concepts, 164.6, pipeline, things like that, and you're going to say, go talk to your accountant and say, hey, listen, I want to make sure that we do this. And your accountant's probably going to say something like, yeah, okay, we will. But like, what do you mean we will? Like it's 30 years from now. Like, are you going to be here? I'm not going to be here because I'm going to be dead, so I can't do anything from the grave. The accountant might or might not be around. They might be
Right.
retired. But more importantly, will those provisions even exist in the Income Tax Act 30, 40 years from now? We don't
Mm-hmm.
know. So all of it becomes very hypothetical. So what we really want to do is we want to set the table. We want to set the table such that we have all these options. And updating your will and making sure there is enough flexibility afforded to the executor so that they can do these things or whatever else exists in the Income Tax Act at that time is very important. And when we're talking about corporate assets, certain provinces, I know BC does for sure, and I
Mm-hmm.
believe Ontario does, I'm not 100% sure on that, allows you to have a second will,
Mm-hmm.
a non-probated will. It is potentially beneficial to have all of your corporate assets. So again, your shares in this holdco
Mm-hmm.
could be basically handled through a secondary will with a
Mm-hmm.
different executor who might have a little bit more sophistication, or you might even want to use a professional executor that can handle that because of the crucial and complex tax planning that goes along with the deemed disposition of the shares of that corporation, right?
Mm-hmm.
So obviously, this is something where you're going to want to have some significant assets in that holdco if you're a physician, but it is something worth talking about depending on the province you're in. So again, now you've updated your will to tease out some of those corporate assets and put it into a separate document, or at the very least, maybe you've provided some more in-depth instructions
Mm-hmm.
as per advice from your tax advisors and on what kind of language needs to be in that will so that the executor knows at the very least go find a tax professional to help you with this part because this part's actually really crucial and we can really save some tax here.
Mehul, back to the corporation for a second. Is there anything that we need to look at with respect to the structure of our corporation, the shares? I know this is a bit of a technical question, but is there anything there that needs to be addressed to make sure that these planning strategies can take place?
I mean, I do believe that the estate freeze is something that really lends itself to this kind of planning. Again, we like predictability as planners. So if we can identify the right time and if an estate freeze really makes sense for you at a particular time, or at least your tax advisor can say, okay, not today, but we know 5 years from now, 10 years from now, or when we hit a value of X, we're going to freeze. Just dealing with preferred shares and having and being able to again set that table and have that predictability makes it a little
Mm-hmm.
bit better. You might want to just make sure you have updated share classes that maybe simplifies things. It's not overly complex. Um, I think part of it might even just be looking at what are the assets inside that corp, right, and making sure you have that you might want to change your asset mix over time to kind of make your estate planning a little bit more efficient. You might even want to trigger gains while you're alive, right? Especially when you have losses to offset and things like that. I think the other thing that would be really important to mention at this juncture that I alluded to before is if
Mm-hmm.
you are going down that estate freeze path,
Mm-hmm.
and in the original example, the holdco was worth 10 million at 10 million of assets, and I'm assuming the real estate inside there was kicking out some income, potentially some net income.
Mm-hmm.
The investment portfolio was hopefully providing some kind of net income. Um, what does retirement look like? So I don't think an estate freeze, especially for an incorporated professional like a physician, is complete without having an accompanying retirement plan,
Hmm.
right? Because if that's what you're freezing, you're basically saying this is my retirement, unless you have, you know, other retirement income, right? And I know
Hmm.
there's a new pension that exists for physicians and things like that, but in the absence of that, or anything else, or an IPP or anything like that, like what is that retirement picture look like, right? And
Hmm.
is there a mechanism, or is there enough cash flow in that holdco to provide you with income until you pass away? Now, and you and your spouse. And what that might actually do is allow you to reduce your tax liability while you're alive. And why is that? Is because when you have these preferred shares, right, and you now need to extract money from your holdco to live,
Hmm.
personally, you do so as a taxable dividend. So what
Hmm.
happens is that the corporation redeems some of those preferred shares from you in exchange for these taxable dividends that are paid out. They pay you for those shares over time. And
Hmm.
that's called a wasting freeze. You start with $10 million of preferred shares, and over
Hmm.
time, you can whittle that down. And if that kind of works with your retirement strategy, that could be a really great way. Say from the day that you freeze and you retire, you might act until you pass away, you and your spouse pass away, you might actually waste away half of those. Yes,
Hmm.
you've paid dividend tax along the way, but everyone's going to pay tax in retirement at some level, right? That's fine.
Hmm.
But at least when you pass away, instead of a $10 million of preferred shares that are going to be taxable, you're going to have $5 million of preferred shares that are taxable. And you funded your retirement.
You said that was a wasting freeze?
Correct.
Okay. Freezes might make for an interesting episode as well one day, but you
Oh, yeah.
mentioned something in your answer there that the asset class mix may make the planning a little bit easier. I don't want to open up a whole new
Mm-hmm.
can of
No, no.
worms, but
Yeah.
are you referring to issues with liquidity, or is there something else when you're talking about the asset class mix? Maybe you could just touch on this.
Yeah, no, I think it's a nuance that's important to get into. So again, if we're looking at your retirement plan and we know that you're going to need income throughout retirement from your
Hmm.
corporation, and you have these embedded gains, and especially when you come into years where there's losses to offset those gains, you can do some loss harvesting. Maybe you get out of that type of position and you get into a position that's paying income on a regular basis, which you're going to need anyways personally,
Hmm.
right? And maybe that allows you again to lower the overall capital gain in your corporation, so that when you do, maybe pipeline planning or 164(6) is not available for whatever reason, and you are going to have this second layer of tax, maybe we can somehow reduce that second layer of tax.
Okay. Okay. All the planning that you've talked about so far, Mehul, how long does that realistically take?
You know, it's a hard question to answer because it's ongoing, and it has to change as tax rules change. And as we've seen in the last decade or so, tax rules can change. So, at the very least, getting your will done should not be a process that should be drawn out too much. Obviously, it does take some thought. If you don't have a holdco yet, opening up that holdco, doing an estate freeze may take a couple months, depending on how busy your tax advisor and the lawyers are to get that done. Um, Once you've passed away, though, executing on that, some of that, like for example, this is a big one, the 164(6) loss carryback. You actually, there are some rules there. First off, your estate needs to qualify as a graduated rate estate. And all that really means is, it's going to take advantage of those graduated rates as opposed to a flat
Hmm.
rate, as most other trusts are. Your estate is considered a trust. And you don't want to do anything that jeopardizes that graduated rate estate status. And what that means is you don't want to taint the estate or taint the trust. And you do that by like the executor lending or putting their own money into the estate or something like that. Like so there's certain rules that you need to follow that the executor needs to be careful about. But it used to be you only had a year to do that loss carryback and then it was
Hmm.
gone. But they
Hmm.
are now hoping, they're requesting, And I don't really know where we stand yet. Some people seem to think it's done, but last I checked, it wasn't actually hadn't received royal assent. But they're looking to expand that to 3 years, and
Okay.
that to me I think is very fair because trying to get it done in a year is very difficult,
Hmm.
considering how backed up the courts are and all that. Right. So that's sort of what I can say around timeline.
Now, our initial scenario, I talked about a holdco that had assets in stocks, private equity, and real estate. Now, I know some people who are much more concentrated in real estate, and let's say the bulk of the portfolio is in real estate, which is going to be illiquid. The estate could then face some illiquidity issues. Mehul, in a setting like this, how can these illiquidity issues be navigated?
Yeah, no, that's a great question, and that really gets into the part that I guess I'm most well versed in. And I will say that it might it not it, the liquidity mismatch, as I termed it, doesn't only occur when you just own something as illiquid as real estate. I would argue that even having a liquid portfolio of investment, stock portfolio, ETF portfolio,
Hmm.
you still benefit from this type of strategy because, again, as we
Okay.
noticed, when you do try to turn that portfolio into cash, because CRA is not going to take your portfolio, they want cash, you are incurring that second layer of tax.
Hmm.
So, is there something we can do? Right. So, we have this tax bill, your state has this tax bill, and we don't have cash, liquid cash sitting in your holdco or personally. Is there something we can do to generate or create liquidity? Okay. Be it in your holdco or personally. Okay. And if it's in your holdco, is there a mechanism to get that liquidity out in a very tax efficient way?
Hmm.
Right. And there's one last thing left here in Canada. And you kind of touched on the mechanism a bit. You said the other, just earlier on, I think, is that you love CDA. That's the account you love. That's your favorite account, right? And because I bet you're not the only one. And so we're gonna sort of use the nature of that CDA, that tax-free nature of the capital dividends that can get paid out, and we're going to use it and increase the balance of the CDA by utilizing corporately owned life insurance,
Okay.
preferably permanent insurance. And, I tend to skew more towards whole life insurance as opposed to universal life. And that's
Okay.
probably a conversation for another day. But the certainties around whole life just seem to jive with me a little bit better. And what we're doing here, and I think you know Amanda Doucette, a
Oh
tax,
yeah.
tax tax lawyer,
Yeah.
and
Of
she's,
course.
her and I have had these conversations before, and she loves these analogies of buckets. And what we're doing here is we're just taking something from a taxable bucket, corporately speaking, that would be
Hmm.
taxable upon redemption or upon disposition, into a bucket that is not taxable. Okay.
Hmm.
And I know there's going to be some people that say, oh, there's underlying tax and all that. I'm saying, yes, there is. I am talking about on death or upon
Hmm.
disposition of the asset.
Hmm.
Okay. And when it comes to insurance, the way you typically dispose of insurance is by dying, right? When you
Hmm.
die is
Hmm.
when that benefit is paid out. And in Canada, death benefits largely are tax free, whether it's paid to a corporation or whether it's paid to the individual. So in this case, the corporation, your holdco, in our original example, would own the policy. The holdco would pay the premiums on an annual
Hmm.
basis, and it would also have to be the beneficiary of the policy. Physician passes away because that's the life that's insured,
Hmm.
and the death benefit is paid to the corporation.
Hmm.
Okay, and I'll get into the details in a bit, but for the most part, most of that death benefit is going to be able to flow out of the holding company to the estate in a tax-free way through the CDA, through that capital dividend account. So that death
Hmm.
benefit minus whatever the adjusted cost basis was of the
Hmm.
policy
Hmm.
at the time of death will be the net credit to the CDA, and that could flow out tax-free. So what have we done? While that asset, you were putting money into the insurance, that cash value was not
Hmm.
attracting any additional tax as, say, a dividend or interest income
Hmm.
from an investment would,
Hmm.
right? And when it's paid out tax free. And then there's that mechanism to have most of it come out of from the holdco to the individual or to the estate tax free. So we kind of ticked all the buckets there. And what we've done now is we've kind of created a solution for that liquidity mismatch.
Mehul, I'm going to ask a very basic question here. We've been talking a lot about holding companies. I have a holding company because there are certain assets that I invest in, like real estate, like rental properties, that I will not own inside my medical professional corporation. But some people don't have real estate. Some people invest exclusively in stocks and ETFs. Basic question. For those people who are in stocks and ETFs only, do they absolutely need a holdco? I have to ask because I know we've talked about holdco so much in this episode, but I wanted to ask you.
Yeah, no, and I go back to the earlier episode you did with Ali Spinner, which I would really encourage your listeners to go back and listen to that because that was a master class in holding companies, and Ali's just
Yeah,
so
yeah, she
brilliant.
she is amazing for sure.
So shout out to Ali Spinner. But you know, I I would say that if you are starting to really build a portfolio, an investment portfolio, even if it's just ETFs and mutual funds or stocks or whatever that is, uh, in your medco, like in your professional medical corporation, I would probably look to have a holding company and have that moved into the holding company. I know that you guys have liability insurance and all of that. Um, in my mind, not a CPA, no, not an in-depth tax advisor, but some of that is on the fringe of the tax planning world. It's just cleaner,
Okay.
right? Now, I also understand that those medcos are not sellable. It's not a business that you can typically sell. I don't know if that changes down the road.
Hmm.
I don't know. I also don't want to give a blanket answer. Like, what about that physician who is doing, I know plastics and maybe doing like, med spa stuff and cosmetic stuff and there's a bunch of equipment there and all that. Like, is there something there that's sellable or, do you want to have that tied up together? Yes, there is a frictional cost, obviously, of having a secondary corporation that requires filing and all that. But if it provides more peace of mind and makes things a little bit cleaner, it might be something worth looking into. I don't think, just because I like to be definitive, I don't think you necessarily, it's mandatory to have one. You could probably do fine without one. But just make sure how you're keeping things clean. Um, the whole idea of like small business rate and all that, and how passive income can grind down that business rate, it's not really applicable because it's all connected companies that holdcos. It's going to do it
Hmm.
anyways. And
Hmm.
again, that's a holdco episode that you can get into all that stuff.
Mehul, when I asked you the first question on the various layers of tax, you talked about the three layers, and you mentioned that if no planning is done with the three layers of tax, the effective tax rate could hit maybe, let's say, 70%. Now, if planning is done optimally, are there any ballpark numbers you can kind of give us to share, like the benefit that good planning can have on dragging that effective tax rate down?
Yeah, I mean, if we hit that perfect scenario of, we're able to, first off, again, I have to stress, like this is the perfect scenario. Everything has to line up, but individual passes away. They got all these assets in a hold co. They had the life insurance, so that created the liquidity. And the other point I wanted to make the life insurance is because it created that CDA credit,
Mm-hmm.
it really pairs well with that 164.6 loss carryback, right? Because remember, we
Mm-hmm.
converted that capital gain into the dividend, but now we've created a mechanism to get those dividends out because we created that
Mm.
CDA, right?
I
You
gotcha.
see what I'm
I
saying?
gotcha.
So
Yep.
it really does marry quite well. So when you do start combining 160, like let's say they're all available, everything kind of works out here. You've got some 164.6 that you can do.
Mm-hmm.
You're getting a big CDA credit from the life insurance. You can't use it all with 164.6. You're actually limited to 50%. So only 50% of that dividend can come out tax free from the 164.6, the loss carryback. And and you have some pipeline availability, you have the ability to do pipeline, you could
Mm-hmm.
probably bring that 60, 70% tax down back to like, 30 or under,
Okay.
right? But again, at the very least, even if you're only doing one layer, the calculations that I've run before can bring that 60, 70% down to like 40%. So it's still
Okay.
like very material.
Yeah, more palatable for sure. Mehul, so in this process, we're always going to need our accountant. We're going to need people like you, a certified financial planner, a trust and estate practitioner. We're probably going to need a tax lawyer too. Just summarize for us briefly, if you can, like who are all the people that we are going to need to touch base with to make sure that the planning is done right?
Yeah, that's an excellent question. And I want to preface my answer by saying the best outcomes for the physician, for the client, occurs when all advisors are at the table together, not working in silos, but collaborating and making sure that nothing falls through the cracks. So, who do we need? You need a tax, competent and well-versed tax accountant. So, not a bookkeeper, not someone that just does files your returns, corporate and personal returns, but someone that preferably has done the in-depth tax program and really understands taxation, corporate tax. And so that's one piece.
Mm-hmm.
If we're talking about getting your estate documents done, your wills, your POAs, and all that, you want to make sure that you have a good estate planning lawyer that's well versed in those documents and again knows a little bit about tax. They don't have to be a tax lawyer,
Mm-hmm.
right? But if they know a little bit about tax, that would be fantastic. You and they probably will. There's very few estate only planning lawyers. They probably have some corporate law. But they probably do a good chunk of corporate law as well, so that's helpful in case you are opening up other companies and things like that. You definitely want your investment advisor or wealth planner there, your certified financial planner, to take care of that retirement planning piece. So that really makes sense, and it's like all working with everything else that we're doing. If you are considering or looking at insurance, you do want a well experienced insurance advisor that has some good tax background, some good tax knowledge, right? Typically, that CLU, TEP designations that an insurance advisor would have are
Mm-hmm.
pretty good indicators that they have some good tax base there. And then I would say I mean, yeah, you're going to have your bookkeeper probably already. That's probably like the bench you need right off the bat. Now, you
Mm-hmm.
might have some specific needs that require other individuals that you might want to bring on. But for the most part, like if all those people are at the table together, and at least once a year they're communicating together through some form of a memo or something like that, I feel like good things are going to happen.
I think that's great. And Mehul, let's just close it out with any other tools or considerations or any closing thoughts that you want to share with people today.
Yeah, the Income Tax Act in Canada is very complex. The tax system, the tax rules are complex. It's not something you go at alone. I think we've made that point today. And estate planning, estate tax liability is just one piece of the puzzle. There's so many other parts are that involve tax and have to do with tax. So really get that advice early and build that team early. And you're going to spend a little bit of money, but it's going to save you a lot in the long run, right? Um, Also, right size. You don't have to get the holdco and the family trust and the this and the that all on day one,
Mm-hmm.
right? Your plan will evolve over time, right? You might have people that tell you, no, just get it all done right off the bat, right? But it might be not just expensive, but it might also just be a bit overwhelming and a bit overkill right off the bat. You start with your incorporated, medical corp. You add in the holding company when it's right. Maybe you get married, you have some kids. It makes sense to have a family trust. Maybe you go back and implement that down the road, right?
Mm-hmm.
Yes, there's going to be some, again, costs associated with that, but I don't know if that's going to be the big barrier for individuals. I think what it's going to be is more around the time and finding the right people that they trust to help them. And then, of course, coming to terms with the complexity, right? Because most individuals and most physicians that I work with, they want to understand things. They're not just blindly like, oh, yeah, let's just do whatever you say. They want to have a good grasp on what's going on. And this stuff is fairly complex and not like anything else you might have seen before. even if you look at like, people that DIY investments and things like that, the markets are complex, but this is a whole different beast because there's
Yeah.
so
Yeah.
many little rules and things that can get tripped up. So find someone that can explain it to you big picture. I think that's a big thing.
I love it. I think that's really well said. And I also do want to let listeners know Mehul does a really good job on LinkedIn presenting case studies. I have to say, Mehul, those are some of your posts that I have really enjoyed and learned a lot from because
Thank you.
the scenarios that you paint out, it could be us. And I think the way you take us through it, it's quite easy to understand, quite relatable. So I encourage people to check that out.
Thank you so much. I appreciate it.
All right, Mehul, it's my pleasure and always so much fun to sit down and talk with you. I really appreciate you making the time for us today.
It was totally a lot of fun. I always love chatting with you, Yathin. You do an amazing amazing job at this show. I've always been a fan of it, and wishing you continued success.
Hey, thanks, man. Appreciate that so much. Okay.
Take
Have a
care.
great one.